So just a few weeks ago, I made a video on this channel and I was talking about how the fear greed index, this needle was all the way to the left at the extreme fear category at a level of 4. I was telling everybody to buy stocks at that level right there. Things were cheap, things were beat down in price, and it was a great time to sell put options and buy call options. So now I'm telling you that it's a great time to trim some of the risk assets that you have in your portfolio, such as options or any leverage that you might have, or even margin at that. Trim some of that and put it on the sidelines and wait. And I'm going to explain to you why in this video you should do that, because there's some very, very bad things popping up in the market right now that is a great time to sell while things are still up. Because we made a really big move off of this April 4th low, the NASDAQ is now up 22% off of that bottom right there. You don't want to get caught carrying this all the way back down when the market corrects lower if it does. And by the end of this video, you're going to understand exactly why it's likely that we do retrace a little bit of this gain that we had right here and actually go down a little bit. So we bought here, we made a lot of money, and honestly, the market went up a lot faster than what I thought it would. 22% in just a few weeks is amazing. We made a lot of money, but now that we went up so much so fast, it's now time to take a little bit of profit and trim a little bit of risk out of our portfolios. So one of the most concerning things right now is that the stock market is potentially in a bubble, and this chart is going to explain pretty clearly why it's actually very possible. So this shows you the PE ratio of the Mag 7 stocks, which are Google, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. Those are the 7 stocks that are included in the Mag 7, which is the red line right here. The blue line is going to correspond to the S&P 500, and then the green line is going to be the S&P 500 without the Mag 7 in it. So the Mag 7 is definitely valued pretty lofty right now, and the question is like, how much higher can it keep going? Because the S&P 500 and the whole market itself is so heavy in Mag 7 stocks that if the Mag 7 goes down, pretty much everything else is probably going to go down with it. So that's a major problem. So that's why the Mag 7 valuation level matters a lot. So if we go all the way back to 2013, you can see the Mag 7 PE ratio was around 12, pretty fairly valued at that time. But if we go to right now and we look at the red line, it's 27.5. So the PE ratio for the Mag 7 going forward is pretty expensive. And understand that this is on a forward basis, not a trailing basis. So forward basis is including earnings that are expected to grow in the next year, and then it factors it into this PE ratio. So on a forward basis, the PE ratio should look better. It should look even cheaper, but it's actually not. And if we look at this on a trailing basis, this PE ratio is probably going to be above 30, which is relatively expensive. So you can see the PE ratio on a Mag 7 went from roughly 31 all the way down to 22. So down here, it was a pretty good buying opportunity. But now that the market rebounded so sharply, PE ratios actually expanded quite a bit because earnings didn't go up that much. So when earnings don't go up a lot, but the stock price does, that's going to make the PE ratio go up quite a bit. And that's why we're down here at 27.5. Actually, I want to say up here. We're not down here. We're up here at 27.5. It's a little bit expensive. Also, you could correlate that to the S&P 500. Right now, it's at 21.4. It did go all the way down to roughly 19, and it was pretty close to intrinsic value down here, meaning just the true value for the S&P. But now it did expand quite a bit, and we're all the way up here at 21.4. So again, the market is a little bit expensive right now, and everybody wants to know, is it too late to buy in? Do I sell? Do I buy? What do I do with all my money? Let me explain a few more charts to you, and then I'm going to answer that question at the end, because you're going to have more context and more clarity on exactly what's going on in the market in real time. So let's look at the next chart. Now, to build on that chart, we have to look at this chart, because this one is honestly one of my favorite hands down charts to get an idea of the true valuation level of the market. And I know you guys might be bored of this, like, why do we care so much about the valuation of the market? And I promise you, the number one thing that matters in the market is what the earnings of the companies do. If their earnings go up, the stocks are probably going to go up too. And if their earnings go down, the stocks are going to go down. And then it's the earnings versus expectations. So if earnings happen to go up 100%, but the expectation is 50%, you're going to see upside surprise in the market. But if earnings go up 50%, but the market was expecting 100%, you're going to have a lot of downside surprise in the market from that. So remember that the PE ratio of the S&P 500 is roughly 21 right now. So it's relatively high going all the way back to 1985. And the last time it was this high, that was the dot-com crash. And we all know what happened after the dot-com crash. It took a long time to make your money back to get back to even. We're at a very similar valuation level as that right now. So the question that we have to answer is this. Is it a good time to buy into the market right now, or do we sell? Well, let's look to the left and see what history says. 1999, the valuation went all up to like 24, 25 almost for the PE ratio. And by the way, these blue lines correspond to the PE ratio level that the red line, which is the S&P 500, will be trading at if the S&P was at that level. So back here was 24, 25. Right now we're at 21 or 22. And at the end of the '08 financial crisis, it was almost at a level of 10, so relatively cheap. So going back to 1999, the market was at 25. You could saw the market went down quite a bit, went back up, and then went back down again. But all this time right here, yes, you would have broke even right here just barely. But then you caught this massive move down right here. So really for you to make any money at all in the stock market, if you would have bought the top in 1999 or 2000, it would have taken you from 2000 to roughly 2015. So it's roughly 15 years to get even on your money. You barely would have broke even right here, so I know that the data will reflect that. But to truly start actually making money, it's going to be roughly 10 to 15 years if you bought the top right here. Now, I'm not saying we're going to have this massive crash right here and the stocks are just going to fall for years and years and years. What I am saying is this. Let's compare this to the opposite side of the argument. Look at what the valuation level was at the end of the 2008 financial crisis, all the way down at a PE ratio level of 10. When the PE ratio was 10, look at what happened from 2010 to right now. The market absolutely exploded. Yes, we had COVID. Yes, we had higher interest rates and the market went down because of that. There was a lot of things that happened in this time period, but the trend is very clear. The market went straight up. So now that the market is all the way up here in this valuation category that we only saw one time here, and one time right here, all the way back to 1985, we are in territory where the market is probably going to correct lower. And it's no surprise that Warren Buffett has so much money in cash and treasury bills and he's not deploying a lot of that capital and he's actually selling some stocks because he realizes that the valuation level of the market right now is a little bit lofty at a time that interest rates are actually going up. Yes, the bond yield in Japan is going up, the bond yield in America is going up, and this is going to cause problems for the stock market. So let's cover that. All right, now without boring you to death, we're going to talk about the Japan bond yield, the US bond yield, and what typically happens in the stock market when bond yields actually go up and why it's usually bad for the stock market. And then after that, I'm going to show you what I'm exactly doing in my portfolio to capitalize on what's happening in the market right now. Because honestly, if this plays out, it's not going to be good, I promise you. So this is a 10-year bond for Japan, and yes, it's only at 1.5%. Now, if we go back just a few weeks ago to April 4th of this year, the 10-year bond was at 1.16% for Japan. Now it pumped all the way up to 1.5%, and it's causing a lot of problems in the market. So there's a thing called the Japan carry trade, and the last time that it played out just like it's playing out right now, the stock market went pretty much straight down in a very, very, very fast way. And all this is at a time that the market went straight up, so now the market's dying for a negative catalyst to go straight down. So let me explain how the Japan carry trade works in a perfect situation. So typically you're going to borrow from Japan at say a 1% rate, and you're going to take that money and go invest it in US Treasury bonds, which right now are yielding like 4.5%. So 1% right here, 4.5% right here. So in theory, you're making 3.5% on the spread. So you take this 4.5% payout from the US government, and then you take those earnings and go pay back your loan that you took in the yen, which is at this lower interest rate. But now that the Japanese bond went from 1.1% to now 1.5%, the cost of borrowing is also going to go up in Japan. So there's less money to be made right now. If you borrow from Japan at say 1.5% and then a 10-year bond in the US is at 4.5%, now this spread is 3% versus 3.5% earlier. And I understand that's only a 0.5% difference, but if this gets out of control, it's going to put a lot of pressure on investors to then go sell US Treasury bonds. And what happens when you sell US Treasury bonds is the yield is actually going to go up. And you could see that's exactly what's happening right now. So April 4th of 2025, the 10-year bond in the US was at 3.99%. Now it's all the way up at 4.48%. So technically this makes the Japan carry trade less of a factor, and that's actually a good thing, but it's creating another problem. The problem is this. As interest rates go up on the 10-year bond, that's making the 10-year bond more compelling to attract new investors' money. So when new investor money comes into the 10-year bond, where's that money coming from? It's typically going to come from the stock market. So when people don't want to invest in the stock market and they want to go put their money into the bond market, what do you think that's going to do for the stock market overall? Stocks are typically going to fall. And after we just made this pretty big run in the stock market, a negative catalyst like this where bond yields are going up and Jerome Powell at the Fed is signaling that he's probably not going to cut interest rates in the near future, this is technically bad for the stock market and stocks could fall quite a bit. Because remember, money always wants to find the best risk-adjusted return. And if you don't believe me, take a look at this chart right here. So we're going to compare this chart, and it's going to become crystal clear exactly why right now might be a bad time to hold some stocks and why it could be a really good time to capitalize on the money that we made and sell a little bit of our positions. So if we go back to 1980, you'll see that the federal funds effective interest rate was 19%. Absolutely astronomical. And you're going to say, well, this is the federal funds rate. This is not the bond rate. But the bond rate was very, very similar back in the same time period. Bonds are very similar to what the federal funds effective rate is. So 19% in 1980, right now we're at 4.33%. Now, if we look at what happened to the PE ratio of the S&P 500 in the same time frame, 1985, it was down here at 9, and right now we're at 21.7. So as interest rates fall and bond yields fall, which they did in this whole time period right here, you could see that stock market valuations go up. So they move inverse of each other, and it makes perfect sense. As bond yields go down, people don't want to put their money in bonds as much. And when they don't want to put their money in bonds as much, guess what's going to happen? They put their money into the stock market, and that's going to bid up PE ratios and make them more expensive. So the point that I'm trying to get at is this. I said it 500 times on this channel. I'm going to say it one more time right now. Interest rates are gravity on the stock market. If interest rates keep going up, that's going to put downward pressure on the stock market. But if everything stabilizes, if inflation keeps going down, the Fed is probably going to feel more comfortable to then cut interest rates, and that's going to be bullish for the stock market. The stock market right now is a little bit lofty, but if earnings continue to grow pretty solidly and interest rates happen to go down, the market's going to be fine for the next few years. But if earnings don't happen to be super good in a quarter's coming, or the Japan carry trade things get out of control, or inflation actually goes up, that's going to keep the Fed wanting to have rates higher for longer, and that's bad for the stock market. So this is what I'm doing in my portfolio right now. I did a little bit of de-risking up here when valuations were a little bit expensive, and then Trump did Liberation Day and all this tariff stuff happened, and the market went pretty much straight down. When there's a crap ton of fear in the market on the bottom right here, I was buying calls, especially on United Health, and I was selling puts on companies like Triple Q, Nvidia, AMD, Meta, and a couple other companies. Now that I sold those puts on the bottom pretty much and we caught this big bounce, it's a great time to close out all those trades that I made because the market made a huge move, and then we sit and wait for things to happen. I'm not saying that the market's going to go straight down, but if it does, I wouldn't be surprised if we get a little bit of a correction. But if we don't correct lower, I still have a lot of leverage plays open right now to capitalize on the upside. So long story short, I'm going to win either way. Now, if you want to completely change your life and learn exactly how I trade stock options and how I scaled my portfolio to millions of dollars in a short amount of time, click the link below. You're going to come to a website that looks like this. You're going to get access to my proven course and my mastermind Discord all under one subscription. It's super, super cheap, and you could cancel whenever you want. Be sure to check out all the reviews. There's dozens and dozens of reviews right here. There's a lot of stuff that you're going to learn right here. You could scroll through that. And exactly what happens right after you enroll, it's going to completely blow your mind. Prices are going to go up soon, and it's going to be limited to a certain amount of people. So if you're interested in this, definitely click the link right here, and you'll be set up, and I'll see you guys in there.